Anyway, maybe I might just go on a bit. Back to Hyman Minsky. I've been talking about the Australian government being a currency issuer, and I've sometimes used the word money. I've said when the government spends, it creates money. Well, absolutely. And when the government taxes, it destroys money. That's actually literally true. Banks, private banks can create money by lending. They can't create what we're going to call currency. There's a distinction there. There are different types of money. Government money and private sector money are not the same thing. Hyman Minsky, a long time ago, said, well, in principle, anyone can create money. If you perform some service for me, and if I give you an IOU, saying that I'll pay you $1,000, and if I'm well known and have good credit in our community, then that $1,000 IOU I've given you, somebody else might take that from you in return for goods and services, and it could start trading as money. Anyone can create money. The problem lies if we're talking about money as being a generally accepted medium of exchange, being accepted in the community generally in exchange for goods and services. The problem lies in getting it accepted. Well, your deposit with your bank is part of your bank's debts. It's an IOU your bank has to you. When your bank lends to you, if they give you a deposit at the bank on which you can draw, which is what sometimes happens when banks lend to you, actually you are exchanging IOUs. The bank has a financial claim on you. You promise to pay the bank back over time with interest. You have a financial claim on the bank. You've got a deposit at the bank. If you want to spend out of that deposit, if it involves a transfer of funds into somebody else's account at a different bank, well, your bank has promised to arrange that for you, and they'll arrange that for you using the government money that they hold at the RBA. If you want government money yourself in the form of physical currency, well, your bank's promised to give it to you. If you're going to use your bank account to pay your taxes, to discharge your liability to the government, well, actually your bank will do that for you. There's no way of you directly doing it. It's your bank using its holding of what we call its exchange settlement account, its holding of government money at the RBA. Because our deposits at our banks, we are confident that we can convert them into the currency which our government and the RBA issues at par, dollar for dollar, and there's no risk of that not being the case. Because of that, we accept the funds that we've got on deposit at our banks as having value in exchange, as being money, as being a monetary asset. But in a sense, it's a little bit similar to the story I told you a minute ago, where I had a debt to you and I had a good credit rating, you had reason to trust my IOU. Anyway, that's what Hyman Minsky had to say about money. Over here we have John Maynard Keynes. Now, I'm going to be arguing, before we finish, if I go very quickly, that we shouldn't be thinking of government debt as debt at all in a country with a monetary system like Australia. And it always helps to have someone like Keynes to quote here, so I've taken a footnote from the general theory slightly out of context. What Hyman Minsky's just said, basically, over here, is that all money is debt, but not all debt is accepted as money. Over here, well, if all money is debt, then we can draw the line between what we regard as money and what we regard as debt, perhaps at whatever point is most convenient for handling a particular problem. A 5-year term deposit you have with your bank is included in the money supply in Australia, in the broad measure of the money supply anyway. A 5-year government bond is at least as safe, if not safer. Very similar asset, actually. More liquid, in fact. You can more easily get the cash back before maturity because there's a very liquid secondary market for Treasury bonds. Why don't we think of Treasury bonds as being money rather than debt in the conventional sense at all. Why might it make sense to do that? It might make sense to do that because it would change the discourse. It wouldn't change anything that really mattered fundamentally, but it would change the discourse. Nobody would talk about the possibility of the government running out of money. Barnaby Joyce did this on Q&A a few years ago. He started going on about we might have to fire all the school teachers and all the nurses because the government's going to run out of money if we keep going on like this. Nobody contradicted him really on the panel. Somebody tried to contradict him from the audience, but it's nonsense to talk like that. Anyway, how does our monetary system work? We've got the Treasury over here, and the Reserve Bank, which is owned by the Treasury. And if we're thinking about the people on the board of the Reserve Bank who make the interest rate decision on the cash rate every month, they're appointed by the Treasury. 3 of them are ex officio. One of those 3 people is the Treasury Secretary, is the Chief Public Servant in the Treasury, who's on the RBA board. Then there's the Governor and the Deputy Governor that the government appoint, and then they appoint another 6 people for terms of 5 years, but they're appointed by the government. Yes, they make interest rate decisions. They have done since the early 90s, in a sense independently of the government, but they're pursuing an inflation target which was negotiated between the government and the RBA. They operate under the terms of the RBA Act, which of course is laid down by politicians. Basically, the Reserve Bank has only a very, very limited degree of independence from the government and is best thought of as part of the government. Now, it's a little bit more complicated than this, because the Treasury thinks it can save money sometimes by having some of the government's transactional accounts, some of the agencies that make up the governments having transactional accounts with private banks. But that's just a complication that we won't worry about. For the most part, the federal government banks at the RBA. The official public account, or more correctly, the official public accounts group, is managed by the Reserve Bank of Australia. It's just a bookkeeping item, if you like. Sure, the government has a balance at the RBA, but it's not included in any official measure of the money supply, and it could be anything really. Until 1982, the RBA regularly bought and held on to Treasury bonds that the government issued. The government still has, although they don't use it very much, but the government still has an overdraft facility at the RBA. The RBA and senior officials of the RBA have regularly, when we've asked them, said there are never any circumstances where they'd ever bounce a cheque of their owners, which is what the Australian government is. And by the way, to the extent that the RBA does own government securities, sure, the government pays interest on them from the official public account. That interest then becomes officially part of the RBA's profit, and then it's paid back to the official public account again in a dividend. That's how it works. It's all really complicated when you start talking about it, but it's all smoke and mirrors. Who else banks with the RBA? A lot of foreign central banks do, and 1 or 2 other weird and wonderful institutions we won't worry about, but basically our banks and authorised deposit taking institutions, they have things called exchange settlement accounts. They have exchange settlement account balances at the Reserve Bank of Australia. We have one monetary aggregate which is called the monetary base, which doesn't include very much. It's got about $115 billion in it at the moment. It includes the physical currency that you and I carry around with us. There's about $75 billion of that in the economy right now. And there's another 40 billion or so, which is the exchange settlement account balances of banks and other authorised deposit taking institutions in Australia. That's the monetary base. That's government money, if you like. That is what's been spent into existence by the Treasury or lent into existence by the Reserve Bank of Australia. That is the currency which it is necessary for the private sector to have to pay its taxes. Money is that which is necessary to pay your taxes. Taxes are paid using those exchange settlement account balances. You think you're paying your taxes to the government. In fact, your bank is paying your taxes using its exchange settlement account balance. Your deposit goes down, so your bank's liability goes down, but the bank's exchange settlement account balance goes down as well, so the bank's assets go down by the same amount. Those exchange settlement account balances are also used for, all of us to make payments, and for the sake of this diagram, the state governments are over here with the rest of us in the private sector. They don't bank. There are some state government balances which are not important at the RBA, but state governments basically do not bank with the Reserve Bank of Australia. The government of Victoria banks mainly with Westpac, for example, but the different state governments have different arrangements in terms of their banking, just like the rest of us do. And if you want to make a payment to the government of Victoria, maybe you have to. Maybe you've got to make a tax payment to the state government. Well, technically what's happening is that your bank's exchange settlement account balance is being debited by that tax payment. And in this case, Westpac has its exchange settlement account balance credited. That's how it works. Millions of transactions taking place over time. We could, again, get very complicated because we are in the middle, literally in the middle of a transition in Australia from retail transactions, like I was just describing, being batched and cleared irregularly over time. It used to happen once a day, more recently 5 times a day. We're in the middle of a transition to real-time gross settlement, even for retail transactions, which we didn't really until recent years have the technology to deal with, but many of us can now make these real-time payments using a system called OSCO, if you want to check it out through your bank. Anyway, it doesn't change essentially the fact that the Reserve Bank, our central bank, stands between the federal government and the rest of us. And the deposit-taking institutions, why do you and I and Malcolm Turnbull and the government of Victoria and Kim's Cafe, wherever that is, why do we see our deposits with these banks as big money? Because we can transfer funds to others, or most importantly, because in a sense this drives money, we can pay our taxes to the federal government via our bank's exchange settlement account balances. Broad measures of the money supply include currency, don't include exchange settlement account balances because they'd sort of be double counting if they did, but do include all of our deposits with the banking system. And banks' exchange settlement account balances are a very small proportion of our deposits with the bank, something like 2% at the moment. So there are different forms of money. At the top of our monetary system sits the Commonwealth or federal government. And I was just talking about the monetary base, the cash or currency we carry around with us, and the tiny amounts which our banks hold in exchange settlement account balances. In America, there are minimum ratios for cash balances that private banks have to hold at the central bank. There is no minimum in Australia except 0. They're not allowed to run overdrafts on their exchange settlement accounts, but they don't hold very much in their exchange settlement accounts. They hold a bit more than they used to because of the change I was talking about before, because of the change in our payments system in recent years, but they still don't hold very much. It's not very profitable to hold exchange settlement account balances. Go on.
Is that interest bearing?
It is. I might tell you about that in the next slide or two. But yes, currency doesn't pay interest, exchange settlement account balances do. Not a commercial rate of interest though, not a profitable rate of interest to receive. Down here we've got your bank's IOU to you. Now why do we accept that as money? Because our bank promises to use its exchange settlement account on our behalf to facilitate transactions for us. But private bank money is further down this monetary pyramid. And I wouldn't be in the monetary pyramid at all if we were talking about me giving you an IOU. But if you wanted to sort of extend it, I guess the rest of us would be down below the banking system. Our deposits with banks are particularly safe since the financial crisis, because if you've got up to $250,000 deposited with a bank, there is now a Commonwealth Government guarantee as well, which means if the bank was to fail, you'd get the money back from the government. That didn't used to be the case. Government money, or central bank money, the monetary base, is sometimes called vertical money. It's passed down to the private sector from the government and the RBA. It is a net financial asset for the private sector. This is money we have, which isn't our debt. Most of the broad money supply, something like 95% of it, money you've got in your bank account, is in your bank account because somebody else in the private sector borrowed it into existence first. Money is created when banks lend, like I was saying before. If a bank makes a loan to you, sure, you owe the bank money, but the bank has put funds in your account. If you spend those funds and you give them to me and I save them, they'll be in my bank account. Did my saving provide the banking system with the cash for you to borrow? No, it's the other way around. You borrowed the money into existence and then I could save it. That's how the monetary system works. Anyway, that's called private money or credit money because it's created by banks lending, or sometimes horizontal money because it's passed across the private sector. You notice there's a difference here. Money that's created through private borrowing is, sure, money that's created now, but there's a debt that has to be serviced in the future. All money is a form of debt. Most debts don't count as money. Vertical money, government money, is, somebody called Randall Wray used this term, I'm not sure it's very elegant, that which is necessary to pay taxes. Twin tops. Horizontal money is accepted because it can be converted into that which is necessary to pay your taxes. In a sense, taxes drive money. When money was first introduced in pre-monetary societies, during colonial times, when colonial powers invaded a society which didn't use money previously, how did they get people to use money? Well, they didn't want people to use money. They wanted people to come and work on plantations or build infrastructure or work as servants or something. How are you going to get them to do that without enslaving them? Well, you tax them. If they don't want to be locked in prison, they have to pay you taxes using money with Queen Victoria's head on. They haven't got any money with Queen Victoria's head on. How are they going to get that money? Well, they're going to have to come and work for you and earn it. So they'll come and they'll work on the plantation, or they'll build whatever you want them to build. Some of them won't do that. Some of them will provide services to other people to get the money. But you've introduced money into a society where there was no money before. That happened in country after country after country. These days, when we talk about taxes driving money, what we mean is that if we didn't have taxes and we did have a government that's spending, 25% of GDP, then over time the amount of money in circulation would go up and we'd end up creating inflation because we'd be spending well beyond the productive capacity of the economy, and then money would lose all value. So we tax now in order, if you like, to reduce private sector spending power, to create room within the productive capacity of the economy for the government to spend without creating inflation. That doesn't mean taxation and government spending have to equal each other though, and normally they don't. Government bonds are not in the monetary base, but perhaps they should be. As I said, government bonds and exchange settlement reserves are quite similar in some ways. Zoltan asked me about whether exchange settlement account balances pay interest. Yes, they do. The RBA pay interest on exchange settlement account balances. So exchange settlement account balances, which are not thought of as government debt, are interest-bearing liabilities of the government or of its central bank. Treasury bonds, which are thought of as government debt, are interest-bearing liabilities of the government. There isn't that much difference between them. Treasury bonds are quite liquid too. Their prices don't change very quickly over time. The secondary market, you can sell them and get the cash back quite quickly. I'd rather think of government debt as being the net money supply. By net, what I mean is actually it's the net financial assets of everybody else. The net financial liabilities of the government are the net financial assets of everybody else. Well, this is the way our system works as far as the cash rate is concerned. As we know, the cash rate is currently 1.25%. Technically, that's a target that the board of the Reserve Bank announces on the first Tuesday of every month. They've just, of course, cut it for the first time since 2016 to 1.25%. This is not, apart from one or two technical things I'm not going to talk about, this is not a rate of interest at which the RBA lends to the banks or pays the banks. The RBA pays the banks a lower rate of interest than this on their exchange settlement account balances. It pays them a 1% interest rate at the moment. It pays them in general, as it says here, 0.25% below the target cash rate on their exchange settlement accounts. A rate below a commercial rate. Banks can approach the Reserve Bank of Australia for overnight lending. If they do this, if the banks initiate this, then they don't do it very often these days. Basically, you'll only do it if you've stuffed up your liquidity management. If it's too late in the day to borrow on the money market and you're worried that your exchange settlement balance is getting close to zero, then you'll borrow overnight from the RBA. They'll charge you a punitive interest rate. That's the ceiling. The cash rate itself, that 1.25% figure, is a target that the Reserve Bank has for the rate of interest at which it wants to see the private banks lend to each other overnight or for 24 hours. And this is necessary, the way our system works at the moment, in order for the system just to continue to operate, because remember, there are millions of transactions taking place every day. So there are funds going out of the exchange settlement accounts of some banks and going in to the exchange settlement accounts of other banks. And in order to facilitate the system to work smoothly, the banks that are accumulating excess funds, well, they don't want to leave them getting a 1% interest rate. They'd rather lend them overnight for 1.25%. And the other banks that are running short, they don't want to have to go to the RBA and pay 1.5%. They rather borrow at that 1.25% cash rate figure at the moment. We've had this system for so long, it's so well understood in what is a relatively simple banking system, that actually when the RBA wants that cash rate at which the banks lend to each other overnight, that rate of interest which is the benchmark that other interest rates are set with reference to in our economy to change, the RBA doesn't have to do anything really very much except just announce the change. Because the key issue that everybody's used to now is there's sort of there's always a 0.25% incentive to lend excess funds from your exchange settlement account balance overnight, whatever the target cash rate is. So if they reduce the cash rate to 1% in the next meeting, then the whole thing will shift down. There'll still be that 0.25% incentive. The RBA doesn't create money to reduce the rate of interest. The RBA does nothing at all except announce a change in the cash rate. That's all that happens. If there was too much cash in the system, why would there be too much cash in the system? If there was too much cash in the system as a result of the government spending more than it taxed, so running a deficit, remember, every dollar the government spends increases the reserves of the banks. Every dollar the government taxes reduces the reserves of the banks. If the government spends more than it taxes and nothing else happens, then the supply of exchange settlement reserves to the banking system will go above the level that the banks target collectively. They'll have excess reserves. You'll end up with a situation then where there's hardly any banks that need to borrow overnight. All the banks have got exchange settlement excess exchange settlement reserves, and if there is any overnight lending, the rate of interest on it will be not the target rate of 1.25%, it will be close to the floor, maybe at the floor. No bank will lend to another bank at a rate of interest below this floor, because that's the rate you get from the RBA itself. On the other hand, if there was a shortage of reserves, why would there be a shortage of reserves? Oh, I don't know, this could be the result of cash that the RBA put in the system temporarily in the past being unwound, having to be paid back by the banks. So the banks' exchange settlement reserves were falling. Or, for that matter, it could be that the Treasury has made a big Treasury bond issue, which private sector investors have bought, and that's meant funds going out of private banks' exchange settlement account balances. The banks are all short of funds now. Hardly any banks have excess funds. Well, if there is a bank with excess funds to lend, it's going to lend them at almost the ceiling rate, because most of the banks now are going to have to go to the RBA on borrow overnight. If the Reserve Bank did not carefully manage the total supply of funds to the system day to day, and the demand for reserves varies from day to day, mainly because of transactions between the government and the private sector, but there are other reasons too, then the rate of interest on the overnight market, the cash rate, would not be equal to the RBA's target. It would yo-yo up and down between the floor and the ceiling. And the Reserve Bank doesn't want that to happen. So the Reserve Bank trades on the money market to make sure it hits the target cash rate. Basically, this is what can happen. If there are flows from the private sector to the Reserve Bank or the government, that can create a shortage of reserves. If the government was running a surplus and did nothing about it, all those taxes would destroy reserves in the banking system, for example. If there was a shortage of reserves, so that the total supply of exchange settlement account balances in the system was below what the banks wanted to hold, then you'd need to add those reserves back to the system if you were the RBA. Otherwise, the cash rate would rise above your target level. You'd lose control of the official interest rate. On the other hand, flows from the government or the RBA to the private sector will create additional reserves. If you leave too many reserves in the system, like I was saying before, there'll be basically nobody will need to borrow overnight. They'll all be stuffed full of cash. And as a consequence of that, you'll lose control of the cash rate. Again, if the RBA didn't pay interest on reserves, the cash rate would fall to zero. Since it does, the cash rate would fall to the bottom, to the floor, to the rate the RBA pays. So the RBA tries to put additional funds into the system when there would otherwise be a shortage every day. As I'm going to explain in a moment before we finish, that's the case most days. The RBA deliberately keeps the banking system a little bit short of cash. When I say a little bit short, they alleviate that shortage every day, but they engineer it so the shortage will come round again in a few days' time and they can alleviate it again. That's what happens. Just put some more cash into the system, stop the cash rate from rising, stop there being a shortage of funds. If there's a surplus of cash in the system, they need to do the opposite. Either the RBA or the government somehow needs to take the cash out of the system, or the cash rate would fall below the RBA's target. I just thought I'd tell you what happened a couple of days ago, because this happens every day. I didn't tell you what happened on Friday. I'm sorry, because I put these slides together a day or two ago. The Reserve Bank of Australia has most days kept the banks short of electronic cash and topped things up. They don't do this usually the way that first-year economics textbooks tell you they do it. They don't buy many Treasury bonds outright anymore. Instead, they mainly do it through Reserve Bank of Australia initiated short-term secured loans. They're called reverse repos. Repo means sale and repurchase. Do you have cash converters here?
Yeah.
Yeah?
Oh, sorry, South Australia.
Yeah, in South Australia we do. I know we do in South Australia. Pawn shops. I don't mean pornography, you know what I mean? Yeah. Pawn shops. Yeah. You can go to a pawn shop and you can sell them your watch and say, I'm going to buy the watch back from you in a week's time. Will you be paying a lower price or a higher price? Higher price. The gap between the two prices will give you an interest rate on that loan. The Reserve Bank of Australia is a pawn shop. They accept, sure, Commonwealth Government securities, Treasury Bonds and Treasury notes. They also accept a wide variety of high-class private sector securities too. You can go on their website and find out about it. Basically what happens, most mornings, the Reserve Bank, first thing in the morning, 9:20 Melbourne time, they'll say, we expect there to be a, I don't know, $1,000 million cash shortage today. We're going to put $1,000 million into the system for, let's say, 19 days. They've got their own reasons for saying that. And they announce this through Reuters and Bloomberg, because you have to do stuff through the private sector these days. It's the law. It's not really the law, but that's the way they do it. And they say, okay, all you members of the Reserve Bank Information Transfer System, which basically means the banks and a few others, bid for the business. What you're really doing is you're bidding for the right to borrow cash for 19 days from the Reserve Bank of Australia. Everybody will bid for it, because if nobody else bid for it, you'd be able to borrow the cash really cheaply. That would reduce your funding costs a bit and you'd make a profit. So everybody puts in a bid. And the Reserve Bank lends the cash to those private banks that offer it the highest interest rate. But for legal reasons, what actually happens is the Reserve Bank buys those securities, including Treasury Bonds, from the private banks now, and at the same time agrees to resell them in 19 days' time, just like you with your watch at the pawn shop. It's called a reverse repo because the RBA isn't doing a sale and repurchase, it's doing a purchase and resale, if you see what I mean, when they put the cash into the system. That's how it works. This happens every day. On the 20th of June, this week, 9:20 a.m. they said they wanted to put this amount into the system for 19 days, and that's what happened. They don't care which bank they lend to, because then the banks can lend to each other on the overnight market at the cash rate and sort things out day to day. They're just trying to get the total amount in the system right. Why did they feed that cash into the system? Well, mainly because they previously fed about that amount of cash into the system a few weeks before, and it was going back out again, so they were replacing it once more. On the 13th of June, they didn't just do this, they do sometimes buy some Treasury bonds outright. So that's why I included the 13th of June. That's the last time the RBA bought any Treasury bonds outright. That puts cash into the system until those Treasury bonds mature. On the 7th of June, they overdid it a bit. They don't always get things exactly right. And they talk to the banks, and after all, although we've got 100 authorised deposit-taking institutions, but there's only 4 of them that are important. So sort of imagine it's not the way to do it now, but they're on the phone to the big 4 banks, and of course they know what's happening between the Treasury, the government and the private sector too, but at 9:20 on the 7th of June they put about $4 billion, sorry, it wasn't $4,150, it was $4,150 million into the system for 19 days again. It's not always 19 days, it's just coincidence. But they sometimes, at 5:10 in the afternoon, have another round, in case they haven't got it quite right. And what happened on the 7th of June was that they worked out later in the day, we put a bit too much cash into the system. If we don't do something about this, there'll be a surplus cash, and the cash rate will fall below our target. So we'll take it out again. This is a straight repo. What do I mean by that? Later on in the day, the Reserve Bank said, we don't want to lend more to you, we kind of want to borrow it back again. Only for 5 days. Don't ask me why it was for 5 days. Borrowing it back again, well, that means the Reserve Bank selling some securities from its balance sheet to the private banks and agreeing to repurchase them in a few days' time. Just fine-tuned the amount of cash in the system. It's ridiculous, isn't it? It's so complicated. It doesn't need to be this complicated. But basically what's happening is day to day, the demand for reserves from the banks in their exchange settlement accounts goes up and down for a variety of reasons, including what they expect the government to do soon. And the RBA has to meet it. The RBA isn't choosing how much to put into the system every day in order to do anything other than to meet the demands of the banking system with cash. When there are surplus funds in the system, this is important. Why does the government issue Treasury bonds in Australia? In order to more or less exactly match the gap between government spending and taxation. When we moved to the current system in 1982, the Reserve Bank told us, and you can still find this on the RBA website if you look carefully enough, They did it to help the RBA manage interest rates. Until the 1970s, interest rates in Australia were highly regulated, were not set through the market, basically. Banks didn't pay interest on deposits anyway, not transaction deposits, and interest rates on loans were highly regulated. At the end of the 1970s, Australia moved to a more market-based system, and the Reserve Bank then basically had to do what they do now, really, which is to manage the supply of cash to the private banks to try and ensure that the cash rate stayed at the RBA's target level. But a problem they had was that until this point in time, it was commonly the case that the government would spend more than it raised in taxes, but then wouldn't sell enough Treasury bonds to the private sector to absorb the extra cash that had been created, because they just sold whatever Treasury bonds investors were prepared to buy at interest rates, or yields, that's the word they use for it, that the RBA chose for the government. So if there wasn't enough demand from the private sector for Treasury bonds, they just didn't sell any. It was called the TAP system. The RBA bought them. That doesn't happen anymore. They stopped doing this. Not that it's illegal, they just stopped doing it in 1982. The reason why they stopped doing it was because when those bonds were not sold, what happened was the reserves stayed in the system. So you created a surplus of reserves, and the RBA would have needed to engage itself in a very high level of transactions in order to keep control of interest rates. So to help the Reserve Bank manage interest rates by managing the supply of cash to the banking system in 1982, they introduced the auctioning of long-term Treasury bonds and short-term Treasury notes by the government in whatever amount was necessary to stop government spending creating excess reserves in the banking system. That's why they did it. Not because they need to borrow the money, in other words. In order to obscure things even more, to make it look as though the government needs to borrow money, in 1999 the RBA stopped being responsible for doing this at all, and the Australian Office of Financial Management, which is part of the Treasury, now deals with the issuance of new government securities. But of course it has a big impact on flows of funds into and out of private bank exchange settlement accounts. So they have to coordinate this very carefully with the Reserve Bank if the Reserve Bank is going to keep control of the supply of cash to the banking system. It's not independent of what's happening in government. Anyway, how's all this worked? Well, the current system in all its detail came in 1993. That's when the RBA was given the job of actually determining what the cash rate should be. And when they started, they didn't always get it exactly right. So that the actual cash rate, which is the average interest rate on overnight interbank loans, which is collected from the banks by the Reserve Bank, was not always precisely equal to the RBA's target. That's what those black blobs are about. They were trying to get it right, but they didn't get it exactly right early on. As you move into the 2000s, what do you notice about the black blobs? They disappear. We've got more finely defined detail over here because a basis point is 1/100th of 1%. So the scale is different. But even here you can see during the 2000s, since the financial crisis, basically the overnight cash rate the private banks use has barely ever been 1/100th of 1% away from the RBA's target. So the RBA announces the target cash rate of 1.25%, and that is the rate of interest at which the private banks lend to and borrow from each other. They've come to understand the system. The RBA has come to be very good at managing the supply of cash to the system. And when they reduced the target cash rate, which they did at the last meeting, what happens? Nothing happens as far as the RBA is concerned. A lot of people that go to economics classes get taught some nonsense about the Reserve Bank buying government bonds to feed more cash into the system to reduce the interest rate. Utter nonsense, as the Reserve Bank will tell you. They do tell you. They don't do anything, they just announce it. That's all that happens. The whole corridor comes down, and that 0.25% incentive to lend on the overnight cash market, that's still there. Nothing else changes. Now, they're talking about zero interest rates, and when they get to zero interest rates, they'll talk about quantitative easing. What does quantitative easing involve? If we were in Australia to introduce quantitative easing, which we have never done yet, unlike central banks in almost every other high-income country in the world, it would mean the RBA no longer trying to manage the supply of cash to the banking system to hit a target for the overnight interbank lending rate anymore. It would mean the RBA deliberately making the overnight market irrelevant. They would make the overnight market irrelevant by engaging in very large-scale outright purchases of government bonds and perhaps some private sector securities as well to flood the banking system with reserves. It wouldn't be free money, it would be an asset swap. To the extent that the RBA was buying government bonds the private banks owned, well, not just the private banks, the private investors owned, from the private sector, and was paying for those government bonds by creating additional exchange settlement reserves, then, like I've just said, government bonds are an interest-bearing liability of the government. Exchange settlement accounts at the RBA are an interest-bearing liability of the government. You are swapping two virtually identical assets. It's not free money. You'd be buying government bonds. What it would do, though, and what it has done in a lot of countries, it would make the ceiling redundant. So in Europe, the only banks that borrow at the ceiling rate from the European Central Bank are basically the Greek banks that are desperate. The overnight market doesn't exist because the European Central Bank keep putting more and more and more reserves into the system, so that the level of reserves the private banks need, oh, what's happened here? Lost my, is far less than the reserves that they've created. What does that do? It reduces the official interest rate to the floor rate. So the official interest rate in the UK now is the bank rate. The bank rate is the rate of interest the Bank of England pays on bank reserve balances. It used to be a rate called SONIA, which was the overnight interest rate between the banks. Banks don't lend to each other overnight in the UK. There's all those excess reserves. They don't need to. All quantitative easing does is it reduces the official interest rate to the floor rate. If you make the floor rate zero, then the official interest rate will be zero. What do you know about official interest rates in Japan and in the Eurozone? Do you know what they are? They're negative. The official interest rate in Japan is minus 0.1%, and the official interest rate for the European Central Bank is minus 0.4%. How is that possible? Well, you do quantitative easing, you flood the banking system with reserves, and then not only do you not pay a positive interest rate on those reserves, you charge an interest rate on them. You effectively tax some of those reserves back out of the system. Again, why would you do that? You're trying to get the banks desperate to get rid of the reserves. They can't lend the reserves to members of the public. A bank can't lend its reserves to you. You haven't got a reserve account. Just like you can't pay money from your bank account to somebody else without withdrawing it in cash if they don't have a bank account. So a bank cannot lend its exchange settlement reserves to you because you don't have an exchange settlement account. What they can try and do is get rid of them like hot potatoes. If they could do enough lending, then the people that they were borrowing to would spend from their deposits, and that would transfer balances to other banks, and then the other banks would be stuck with those reserves with a negative interest rate. That's the idea. It's lunacy, of course it is. It doesn't even work, really. The banks are not foolish enough to take on ridiculous risks like that when they've already got very weak balance sheets and their regulators wouldn't let them anyway, but that's the idea. Okay. Why does the Reserve Bank manage interest rates the way it does. You know, the cash rate, as I said, is a key reference rate for our economy as a whole. If you've got a fixed rate mortgage, then there are a variety of influences on the interest rate you'll pay, but the main influence is what your lending institution expects to happen to the cash rate on average during the period of time when your mortgage rate is fixed. Interest rates to a greater or lesser extent in Australia are linked to the cash rate, which after all is the marginal cost of cash to a bank which is short of cash and has to borrow overnight on the money market. Why would you cut interest rates like they were doing until 2016? They've cut them again now. Because the Reserve Bank has a target for CPI inflation where they're supposed to try and keep the inflation rate within a 2 to 3% range on average over the next 2 years. They have completely failed to do this for about 4 years now. Inflation has continuously undershot the Reserve Bank's target. The economy has not grown as quickly as the government would have liked. Inflation has not been as strong. You must know wages have not been rising. Labour costs have not been rising as quickly as they'd expected. Unemployment is low, but underemployment isn't, as we know. Anyway. Cutting interest rates isn't going to help much. We have all that household debt. And the other reason why it's not going to help much is that, of course, when you cut interest rates, if you've got a mortgage, sure, it means you've got more disposable income. But I've got term deposits. What's it doing to me? There are losers as well as gainers. And if the gainers outweigh the losers, it's not by that much. And on top of that, we've got to a point now where interest rate cuts and talks of zero interest rates and possible quantitative easing are perceived by many people as just a signal that the Reserve Bank is panicking and the economy is actually in a much worse state than they're telling everybody. So you then get that signal, that information, which is counterproductive. You cut interest rates and it doesn't necessarily push the economy forward, it can pull it back. Even if you did push it forward, that sugar hit, if it means households going and borrowing even more, is going to give you an even bigger hangover in the future. So monetary policy is always unreliable, and with the level of household debt we have in Australia at the moment, in my opinion, is basically bust. The Reserve Bank has an inflation target. It has no way of hitting this inflation target. It's relying on external factors.
Philip Lowe thinks that too.
Well, yeah, and well, indeed, he believes that the government should be doing more, but he often contradicts himself. I had an article in Independent Australia earlier this year where Philip Lowe was saying at that time the government needs to pay down its debt. It's important that the government runs a surplus. He's now completely contradicting what he was saying 6 months ago. If he's saying now the government needs to run a bigger deficit.
Has he discovered DMT perhaps?
Well, maybe. I think he's aware of it, but what he thinks of it, I don't know. Fiscal policy works, monetary policy doesn't. Central bankers think they're managing the economy. Warren Mosler says they're like a child sitting next to the driver in the passenger seat with a toy steering wheel. They imagine that they're steering the car. It's the government budget that's steering the car. It's fiscal flows that are steering the car, because they change what I've been calling the net money supply, or the supply of net financial assets to the private sector. Fiscal policy works. Fiscal policy is a job of the government. It's not something the Reserve Bank is allowed to do legally. The Reserve Bank is not supposed to give away money to the private sector. It can lend to certain institutions. It can trade in certain financial assets. It can't engage in well, it's not supposed to be able to engage in government purchases and taxation. That's the job of the government, which has to pass a budget through Parliament. The trouble is our government, and unfortunately the opposition, thinks it has to pay down the debt, which means, imagine, well, you don't need to imagine, maybe you're like me. When they talk about running a surplus, I just mentally change that to destroying money. That's what they're doing. A fiscal surplus involves destroying money. It doesn't add to the ability of the government to spend in the future because the government has a limitless ability to spend. It's the inflation constraint which limits our ability to spend as a whole country without destroying confidence in money. So, why issue debt at all? Why issue Treasury bonds at all? To pay for things? No. You are borrowing back your own currency that you created. You do not need to issue government debt to pay for things. The Bank of Japan in the last couple of years has been buying Japanese government debt quicker than the Japanese government's been issuing it. And the Bank of Japan is effectively owned by the Japanese government, controlled by the Japanese government. The supply of Japanese government bonds in Japan, which is the high-income country with the biggest fiscal deficit at the moment, has been shrinking over time, because as soon as the government issues them, they have the same rule in Japan as in other countries, ridiculously, that the central bank's not supposed to buy significant amounts of government debt directly from the government. They buy it second hand. They may as well buy it from the government. To help the RBA hit the target for the cash rate, there's no need to do that if we, just bearing in mind what we were talking about from quantitative easing, if you just let reserves in the banking system increase, the official interest rate will just change to whatever rate the RBA pays on bank balances. To provide safe assets to savers, allow everybody to hold term deposits at the RBA. Much simpler. Not just the fund managers either. There's no reason why you and I couldn't do it. Allow us all to have term deposits with the RBA. If you want to control the whole term structure of interest rates, that would do it. You destroy a few jobs in a few banks, but they're not doing anything useful anyway. Because there was once a reason. Yeah, actually there was. Gold standard days, fixed exchange rate days. There did used to be a good reason for issuing government bonds, which I won't worry about now, but there hasn't been for 35 years. I think this is just one of those things we do because we always have. What if we stopped issuing government debt? Fiscal deficits would just add to the net money supply like they do now, but you'd be leaving additional reserves in the banking system. The official interest rate would be the floor rate, just like it is under quantitative easing. You wouldn't be issuing government securities at all. It changes nothing much, but nobody would ever imagine the government was going to run out of money again. The issue would then be, how do you balance the economy? You don't want to spend too much. You don't want too big a fiscal deficit. It will create inflation. There's no reason to get rid of that 2 to 3% inflation target. You should keep something like that. Redefine the cash rate as the rate paid by the RBA on exchange settlement account balances. Set that rate low, or maybe, Bill Mitchell would say, set it at 0 and leave it there. It doesn't mean you get to borrow at 0 interest rate from your bank. You're risky. There'd be a risk premium. Continue to spend by keystrokes like you do now, but just leave the additional reserves in the system. Offer everybody the opportunity to hold term deposits at a government bank. You could call it the Reserve Bank of Australia, if you like. Stop talking about the national debt. It isn't the debt of the nation anyway, and the government doesn't have debt in a meaningful sense. Not the Commonwealth Government. Not that they've got to repay ever. Start talking about the net money supply instead. And then start talking about what it would mean to balance the economy rather than the budget. Okay, well, I've gone on quite a long time, but